Alright, so I made this new YouTube channel. It's about value investing. So we're going to talk about how to find stocks that can get you 40% return consistently and how to find value in different sectors. So we're going to go through a spreadsheet that I use to evaluate companies in a sector and find the best one that consistently can make you money over time. And this is a repeatable method that works in almost all market segments. So it's a little bit of a complex spreadsheet, but I'm hoping to find a way to get it out to you guys and leave the information that I've already collected so you have good examples of how to fill it in. I'm working on that, but let me show you how it works. I think if you know what you're doing, you'll be able to recreate it yourself because the formulas are actually above the columns, but it'll be nice to just give it to you so you can start using it right away. So let's see how it works.
So I'm going to show you an example of one of the sectors that I analyzed and the stock that I chose and the stock that I invested in. So to use this method, you don't pick a stock. You might have an idea of a stock, but you don't go for that stock specifically. So for this to work, you pick a sector. So in the last year, I noticed people were buying a lot of bikes, a lot of camping equipment, exercise equipment for their house, and lots of things were out of stock. So I thought about who was going to benefit from that, and I realized that these sporting goods and outdoor stores were going to benefit. So I took a look at that sector, and it turns out there's 3 companies in that sector. There's Academy Sports and Outdoors, Dick's Sporting Goods, and Sportsman Warehouse. So then you go to this website called marketscreener.com, and you type in their name or their ticker symbol, and then you go to the financials page of the website. And this is where you're going to get the information you need to estimate what the price will be of this stock in the next 1 or 2 years. And so what we're targeting is we want our analysis to show at least a 40% return so that we know even if we got something wrong, we'll at least make some money. So to get started, we're going to look up to the end of this year and next year. So you put the 2 years, you put the name of the company, and so just to show you, I did this analysis on this sector in January, and I've been holding the stock that I chose since, and it's up over 40%. So you're going to put the names, the ticker symbol, earnings release date, just to get some information about the company you're looking at, the stock price today, or what it was in January, the number of shares outstanding. And so you're going to notice I'm using all I'm just putting the number there. I'm not putting millions. This is the actual number, because when you start to abbreviate the numbers, it all gets confusing and you don't know what units you're in. So always just put the real number there. So the shares outstanding, you're going to get this number from this website. So number of stocks in thousands. So today, I'm making this video today, but I did this analysis back in January. So today they have 90 million shares outstanding. Back then they had 89 million. So the market cap, you're going to use this capitalization number, PE ratio, and so I'm going to have to make another video that goes over all these useful metrics for these companies. But if you don't know one, just search it and you can figure it out quickly. PE ratio, you can get from this website right here. Dividend yield, so it gives you the yield. So this website is going to give you all these numbers, but we need to put them here so we can compare them and then calculate later. So now we're going to get to the calculation that's going to give us the estimated share price. So there's going to be 1, 2, 3, 4, 5 pieces of information we need, well really 6 pieces of information we need to calculate our estimated share price at the end of the year, the end of the fiscal year for these next 2 years. So you're going to get the adjusted EBITDA, and let me just talk you through what these colors are for. So we're going to be making basically a rainy day estimate, an average estimate, which is the yellow, and a best case estimate, which is the green. And so just to keep it simple on these, for the EBITDA, I'm using my average number plus 5%. And I'm using and for the worst case, I'm using the average number minus 5%. So you can see I just multiply it by 0.95. That way if their estimates are off by 5%, we're going to get some range. So this is going to give us some range, and also the next number is going to give us range. But this adjusted EBITDA you get from the website again. So they have EBITDA listed here. So you're going to take the 2021 number, put it in there, and you can see it changed a little bit from when I did this. And then you're going to put the 2022 number here. So now this should be 730. But I'm showing you my old spreadsheet and the numbers I got back then. And so once you populate this, it's gonna, so let me just show you an example. So when I populate this number, my formula is gonna go ahead and adjust the rest for me, right? So the next number, and this is the important one where you can, this one is critical for your estimate. So you have to be, this is the one you have to be the most careful on, because it requires some understanding and a little bit of skill, and just, you can't mess this one up. So we're going to look at, you're getting it from the website again, it's enterprise value, so EV divided by EBITDA, and this is a ratio. And so you get it from this website here. And keep in mind, we're looking at 3 different stocks, so you're doing this for all these 3 companies. And go ahead and put in, what I do is I usually take the highest and the lowest from each company, and I'll put it in for low, medium, and high. And then you put that in for each company, and eventually you're going to see, okay, the range across all the companies. So I usually take an average of all the numbers I put in here, and I use that as my base for the 3 companies. And then I take the highest and the lowest across the 3 companies and use that for the high and the low for each one. Because the goal of this analysis is that we think one of these companies is undervalued relative to their peers. So we're going to use an average of the peers' ratios to estimate what the value of this company should be. So now that you've got this number, we're going to input the enterprise value. Sorry, you're going to get a calculated enterprise value. So you can see I've got the formula here. I've got EBITDA times the enterprise value to EBITDA ratio equals the enterprise value. So now I've got this number here for enterprise value. Okay, so enterprise value is essentially the market cap plus the outstanding debt the company has. So it's the overall value if you wanted to buy this company outright and own it and take it private. That's this estimated number we've got here. So it's a little different than the market cap, but we're going to come back to market cap to get our share price. So now, this is the same spreadsheet. It's just too long to show on one screen, so I brought it down here. So now, in this next column, we're going to put the net debt, which you can get from, again, the same website. So let's see where we get the net debt. Okay, so yeah, you come down here. This is the balance sheet portion. So they're going to give you a net debt number. You're going to plug that in. And then you're going to subtract that net debt from the enterprise value you calculated. So this is the formula here. And that's going to give you a market cap estimate. Okay. So now that you have your market cap estimate, we're about to calculate our estimated share price. So we're going to divide the market cap estimate by the shares outstanding. That goes here. So you're going to get your shares outstanding from this number you put in earlier. So now we have, and we're doing this for high. We're doing the same thing for the high, medium, and low values. So now we got estimates for each company, and then the final calculation is estimating the rate of return. So you take the current share price, or your estimated share price minus the current share price divided by the current share price. You can see the formula up here. That gives you your estimated rate of return. And so what we want is we want this middle ground and high ground to be at least 40%. And we're going to judge that as a good investment and a company that we want to investigate further. So once you find these companies that have greater than 40% here, next what you're going to do is do your research on them. So listen to their earnings calls. Read the news about them. What are they planning? Listen to the last 2 quarters of earnings calls. Read the earnings reports. And if you hear good things in there, this is probably a good company to invest in for the medium to long term. And you'll see good results. So as you can see, I was estimating 60% return for Academy. Basically an estimated share price of $36 a share, 36 to 44 on the medium and high end. And back then it was 22 and 50 cents, and today it's 41. So our estimate came out right, and we've done well in this stock. So that's how you can find value in sectors. And once again, you're not picking the stock, you're picking a sector, and then you analyze the sector to get the stock out of that sector. And then you go forward, do your due diligence on it. If it's all good, invest in it, you'll do well.
Alright, so that's how I find value stocks. Comment, subscribe, let me know what else you want to know about, and hopefully this becomes a long video series.